Welcome to Drive to FI, and today we're going to discuss 6 reasons why index funds often outperform private equity. The dream of many of us as investors is building enough net worth to be able to invest in a private equity fund as a limited partner. However, private equity frequently underperforms index funds. These mystical, magical funds invest in private businesses and various other securities. I've spent the last 20 years working with and around private equity funds, and there's a real spot for them, but you've got to find the right fund in the right situation, and often those aren't going to be available to you as a private investor. Having such great flexibility and sophistication at the private equity fund level should ensure excellent results, but they're really structured in such a way, and they face challenges that make it difficult for them to achieve significantly better than market results. There's 6 really good reasons to just stick to index funds, particularly if you're a smaller investor. The first one is private equity has very high fees. The only people that consistently make money from a private equity fund are the fund managers. Well, fees vary pretty dramatically. A standard fee structure is 2% of the amount invested plus 20% of the profits. That's called the carry. If the fund loses money, the managers are still going to get paid that 2%. They also, if the fund makes money, may make a very large chunk of any profits. Now, fees have changed a little bit over the years, so sometimes it's a 1% of the profit up to 12% and then 2% of anything above that, and there may be a stair step. But just recognize that if you've ever wondered why private equity managers are often billionaires, you now know why. They get really well compensated on the upside, so a big chunk of your upside goes into the pocket of the private equity partners, and they've got a carry that they're taking money right along, whether the fund's making money or not. Those fees can be really hard to overcome. A 2% fee means you're already 2% behind. And that's an annual fee. Bing, 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 bing. And losing 20% of your profits create an additional burden. Most index funds have fees under 0.2%. And they don't take anything from your profits. Government will, the index fund won't. So you've got a much lower cost structure in an index fund than a private equity fund. Private equity has also, number 2, become too big. Well, index funds are incredibly large. They're indexed to an incredibly large universe of potential investments. And so the size of the public markets is so big that the index funds are always going to be able to invest that money. Many private equity funds have become far too big to take advantage of lucrative financial opportunities, especially in the small and mid-market companies that really do have some market inefficiencies that allow private equity firms to see outsized results. In short, there's too much money chasing too few deals. And when a great opportunity presents itself, private equity can't put enough money to work in that opportunity to obtain the best return. It takes almost as much effort to buy a $10 million company as it does a $150 million company. And when private equity firms are compensated based upon the amount of money they're able to put to work, they look for those larger deals. The smaller deals are ones where there's still opportunity, and most of the big private equity funds have moved away from those because they just can't put enough money to work fast enough in those small deals. Private equity must therefore invest a significant portion of their fund in lower quality investments. And the size of a fund, some of these funds are billions and billions and billions of dollars, tens of billions of dollars. Being able to get that invested at a return that's going to beat the market is very challenging. Warren Buffett has said that he could earn 100% per year if all he had to do is manage $1 million. Investing several billion dollars is a very limiting and very audacious challenge for the private equity manager to be able to beat the market. Number 3, and this is going to be a theme you'll hear here at Drive to FI, the market is very efficient. What that means is that the information available to investors is largely incorporated into the price of stocks. In theory, it is impossible to beat the market. Now, obviously, the market's not 100% efficient since there are investors that regularly outperform the market, like the aforementioned Warren Buffett. However, beating the market consistently is really challenging. Plus, you have to make up for that extra 2% fee. So private equity's got to beat the market by more than 2%. And then you got the 20% profit scrape coming off the back of that. So they really have to do incredibly well. The challenge is being able to find those private equity firms that can do that consistently. And that will prove to be one of the biggest issues that institutional investors as well as family offices and private investors run into. Number 4, when private equity loses money, they can lose a lot. Private equity often takes on a high level of risk. Private equity managers love risk. They're using someone else's money. They're also guaranteed that 2% depending on the fee structure. So any profits greatly increase their income because of the profit scrape. The other thing that I've seen in my 20 years of working with private equity is some of the funds actually charge the portfolio companies a management fee. So not only do they get the 2% from the investors, but they also get paid by the company, the operating company, and take the profits out of the operating company to fund private equity operations. So not only are they largely guaranteed the management fee from the limited partners, but oftentimes they're taking money and siphoning money off from the portfolio companies as a management fee. Any profits greatly increase their income. The high level of risk is also necessary to overcome the fee structure and to provide high returns to investors. So they throw some leverage onto the portfolio company, or they may throw leverage onto the fund itself with fund borrowing to be able to drive up the return to equity. So the ratio of risk to return starts getting high because they're utilizing debt in the portfolio companies and sometimes even at the fund level to be able to juice those returns. So private equity has a lot of exposure with leverage buyouts, and often the companies that they're investing in might be skinny asset companies. So they're not companies with a bunch of real estate and a bunch of hard assets, but it might be intellectual property or other assets that are somewhat difficult to liquidate. Number 5, low liquidity makes it difficult for you, the investor, to get out quickly. If the future isn't looking bright for the portfolio company or for the fund itself, it could take a lot of time to get your investment out of the fund. You might watch your investment shrink daily before you're able to cash out. Depending on the fund, you may also have a capital call requiring you to pay into the fund when you can least afford it. So there may be a situation where the fund is looking to bail out a portfolio company. You've made a commitment to X amount of dollars, and how private equity works is you pay in as they make capital calls. So they'll say, Mr. Jones, please write us a check for $10,000. You are contractually obligated to write that check. Sometimes when the market's going down and you need cash, the private equity folks can give you a capital call and say, you need to send us money now because we're either making an investment or we're bailing out one of the companies in your fund. And you have a contractual obligation to send it. So sometimes you have to pay money in when you can least afford it. Index funds are incredibly liquid. So you could trade in or out of them within a few seconds and at very low cost or free. So some platforms don't charge you anything to do a stock trade on an exchange traded fund or a mutual fund. And you can be in and out within seconds. So there's high liquidity on the index fund side and very low liquidity and a potential for capital call on the private equity side. And number 6, index funds just have too many advantages for the bulk of investors. Index funds can provide comparable market returns with little of the risk found in private equity. The ability to guarantee market matching returns with really, really low fees and a high amount of liquidity can't be consistently matched by private equity. So when I talk about private equity, there's a couple different categories. The first one is you've got your venture funds, you've got your early stage angel funds, and then you've got traditional growth equity and private equity funds. So they span the gamut of these investments that are made into small businesses and sometimes illiquid securities that are generally held for a long period of time. Index funds, on the other hand, are investments into baskets of publicly traded companies. So instead of private companies or publicly traded companies, and you're able to move in and out, and the funds are able to move in and out of those companies very quickly. So index funds have a lot of advantages over private equity. You don't need millions of dollars in net worth to invest in an index fund. You can invest in an index fund for just a few dollars, provided you've got a stock trading account that allows you to invest that way. Private equity is unable to consistently beat the market and overcome the fee structure that is placed upon it, let alone the challenges around liquidity and capital calls. When all of that is considered, the lowly index fund, the boring index fund, is an excellent investment for most of us. If you can move beyond index funds, direct investment in stocks, publicly traded stocks, is probably your next step, where you're making a bigger bet on an individual publicly traded company, but you still maintain a lot of that liquidity and a lot of the transparency into the performance. Moving beyond that, maybe the next step is direct investment into private companies through a family office of your own, developing your own fund to be able to make these types of direct investments. And that may make a heck of a lot more sense than sending your money off to some of the larger private equity funds or venture funds. If you are looking at private equity, you're probably going to want to consider smaller, well-established funds where their thesis is to make investments in small and mid-sized private businesses, so that 10 to 50, 10 to $100 million size. And that's the norm for their portfolio. There's a few of them out there. I've worked with a couple that are really, really, really good, and their track record's really good, but they're smaller funds, and they tend to focus on smaller businesses. If you can get yourself in with those funds, you may be able to overcome a lot of the challenges that I just discussed. But most of the big funds that you've heard about, their challenges, they've got tens of billions of dollars to put to work. It's very difficult to do that. And you're better off, instead of putting your money in those funds, to take a step back and go to the index fund, to direct investment in companies through publicly traded stocks, or even direct investment through your own family office before you go to the massive private equity funds, because it's going to be very difficult for them to find the great returns, and it's going to be very difficult for them to put the money to work, and it's going to be very difficult for them to overcome their cost structure. Keep driving 2FI.